Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. It's been a crazy time these last few days. A lot of tariff talk, a lot of trade talk, a lot of, unfortunately, geopolitical events happening affecting the stock market. We've seen markets go higher. We've seen markets fall. We've seen markets pretty much go sideways for a few days as well. It's been a topsy-turvy, very volatile market. And a lot of questions on investors' minds these days. Been receiving a lot of questions as to what we can expect as we move into August, this being our first show for the month of August. What can investors expect? And we've talked about this on previous shows. I probably would expect to see some volatility entering month of August, which is notoriously a weaker month for the U.S. And Canadian indices, North American indices. We usually see volatility in August and September, September being the worst month out of the calendar over the last 15 years or so, and followed by August. And the good news is we just finished the best month, one of the best months of the year, July being the one of the best months. Actually, November a little bit higher usually than July. So a lot of things to get to today. Let's put up our topics for our show. As you can see, we're going to talk about the U.S. economy slowing. Is it slowing? Is it not slowing? I know if you talk to President Trump, he'd probably tell you that economy is doing just fine. We're seeing, or that he's seeing a lot of gains. He's seeing a lot of money coming in because of the tariffs, because of the trade deals that the U.S. has done. So is the economy slowing? And what does that mean perhaps for interest rates and other things? As always, we have our top 3 things to consider over the next 5 to 10 business days. A very popular segment of our show. We get probably the most questions asked about the top 3 things from investors when they watch or they, I guess, tune in or watch our show later on YouTube or across many other media outlets or social media channels. Stock swings. What do we mean about stock swings? Well, we've seen some really big stock swings. For example, the stock of Meta. Meta was up when they reported earnings this past week, roughly about $80 a share, a huge gain for the stock. And then the following day, it sold off about $23. Why do stocks have swings like this? Does it mean that people had a change of heart, or is it something else? We'll delve into that. President Trump calls on 17 pharmaceutical companies to cut their American drug prices. Yes, we've seen letters sent to the CEOs of the 17 largest pharmaceuticals, and we have actually a copy of one of the letters sent to Albert Bourla of Pfizer, and what the president is asking Mr. Bourla to do, and all the other or many other pharmaceutical companies. What the president is asking, he's basically saying you need to drop your prices. And we'll talk about how low the president is expecting those pharma companies to drop their prices to. U.S. manufacturing shrinks for the 5th straight month. Yes, not many people are noticing this, but it's happening. And we've also seen the lowest factory employment in 5 years, opposite of what the president wants, right? He wants to implement these tariffs to bring back manufacturing into the U.S. He wants to get more people hired into the manufacturing sector, but we're actually seeing the opposite happening. We're seeing less people being hired in the manufacturing sector. And as I said, we're seeing manufacturing shrinking for 5 straight months. Quick hits. This is the part of the show where I talk about 3 things that have been in the news over the, the past couple of weeks. Things that you may have seen or heard about, and I'm going to comment on those. And last but definitely not least, we're going to take your questions. If you have any questions during the course of the show, please feel free to put it in the chat boxes. We'd love to answer them on this show, and if we don't get to them on this show, be happy to answer them throughout the next couple of weeks or on our next show. So without further ado, let's move on with the show. So is the U.S. economy slowing? Well, I think if you ask the President of the United States, he'd probably tell you the economy is booming. that a lot of things are going in the right direction. That the US is taking in a lot of new business from overseas, taking in a lot of money from the tariffs, and making some fantastic trade deals. However, the economic data doesn't really tell us the same story. Yes, we saw some strong data. GDP growth was 3% for the second quarter in the US, although we do know that that was due mainly to a lack of imports. When the US is importing less, bringing less into the country, paying less, obviously, for the goods that they're importing, but yet continuing to export to other countries, yes, GDP definitely looks good. When you're paying less and receiving more money for your exports, of course, GDP is going to move higher. But it's the lack of imports that's the concern. So when you look at GDP, you would say, yeah, the country is doing well. But then you move over to something like, for example, unemployment. We're seeing unemployment rates in the US slightly tick higher, 4.2% on the last reading. And we're seeing jobs growth. Jobs growth is what has spooked the markets over the last week or so. We received the jobs data on Friday out of the US. And yes, it showed a decrease in jobs growth below expectations. Roughly 73,000 jobs were created for the month of July. But it was the revisions that came out to the previous 2 months, June and May. Those were numbers that were not anticipated, and that really took down this market. A lot of people now, a lot of investors, economists, really being fearful of the stagflation worry, which is slowing growth but higher prices. And so I guess it depends on what you focus on, right? If you want to focus on even retail sales, GDP, you might say the economy is doing just fine. But if you want to focus on perhaps the jobs market, or the lack of durable goods spending. That also was disappointing. We received the number as well yesterday, Tuesday, about services, the service sector. That number came in below expectations. So we're starting to see the beginnings of a slowdown in the US. I believe that that is the case, even though talking to Treasury Secretary or anybody in the Trump administration, they would probably tell you otherwise. Our first chart that we have here shows the unemployment, or shows, sorry, the jobs growth by month. And you could see here that for the month of July, we grew 73,000 jobs. And that again was below expectations. Expectations were for about 100,000 jobs created for the month of July. But take a look just to the left of that bar there. We have the revisions. The revisions shaved off 258,000 jobs for the months of May and June. The jobs growth for May, 19,000 jobs created, and for June, just 14,000 jobs. Now, yes, 73,000 jobs, a lot higher. So maybe we saw a bit of a spike for the month of July, or maybe that will eventually be revised downward as well. So jobs growth, definitely disappointing. Our next chart talks a bit about inflation. I wanted to put this chart here because, as I just said, the word stagflation, when you have higher prices or prices moving higher, but you have slower growth, you get stagflation. And we're seeing prices moving higher in the US. We're hearing from many corporations talking about raising prices. We're seeing here we had the PCE, personal consumption and expenditures. We had this data given to us recently in the last week or so. And you can see 2.8% is the core reading, and the headline number, 2.6%, getting closer to that 3% mark. Obviously, as we all know, and as we talk about on this show all the time, we would love to see, or the Fed would love to see this closer to 2%. And now this number is creeping back up to 3%. So higher prices, the unemployment rate slightly ticking higher. We're seeing jobs growth really starting to slow. Durable goods starting to slow. Services, our service sector, which has been the strength, I should say, the US service sector, which has been the strength for the United States, that looks like may be slowing as well with the data that we received just yesterday. So is the economy slowing? Well, I guess it's up to interpretation. Our next chart that we have as well, this is a chart. This shows, there it is, GDP growth. And you can see for the first quarter in the US, GDP growth was a negative number. And now, second quarter, a definite rebound. And again, that was due to a lack of imports coming into the United States. Our next chart, we have one more chart, I believe, here. There it is. And it shows that growth actually accelerated in July as rising demand for services offset manufacturing dip. However, when you look at the last statistic that you have here, which is a flash US manufacturing PMI, 49.5 was the latest reading. We know that any reading below 50 shows contraction. And as you can see here, it is at a 7-month low. And therefore, we've seen a number of months showing contraction in the US on the manufacturing side. So I think you could probably sum everything up into saying that the US economy is definitely starting to slow. We still are seeing some strength in the economy, but definitely tariffs are starting to show up right across the board, whether it's in the automotive industry, whether it's in the housing market or the housing industry, or whether it's in pretty much any industry, pharmaceuticals, probably the only industry that I can think of where we're not seeing really the effects of tariffs as yet in terms of pricing. That would be in the tech space, the tech industry. Technology seems to be moving a lot better, coping with the tariffs a lot better. And I guess it's all going to depend on China-US relationships and how we see those over the coming days and weeks. Can a trade deal or can some more negotiations happen between the two superpowers or the two biggest economies in the world? And I think that will dictate how technology moves and that sector moves. But overall, make no mistake about it, I believe the US economy continues to slow and will continue to slow as we see prices continue to move higher and growth start to slow. And hopefully, for the US's sake, we don't see unemployment rise, but I think that could be inevitable as businesses remain on hold until they get some clarity with respect to tariffs and the economy. Now, the part of the show that I believe individual investors love to focus on, love to hear about. And this is the part where I talk about three things that individual investors need to focus on before you make your investment decisions over the next 5 to 10 business days. And as you can see, a lot of the three topics that we have up on our screen, we've had many times before. And it just seems like the same themes keep popping up week after week. And they're the themes that continue to control the way the market moves. And investors are keeping an eye on these things. And number one, Fed speak. We're hearing a lot about the Federal Reserve. We continue to hear the pressure that the President of the United States, President Trump, puts on the chairman of the Fed, Jerome Powell. It seems like every day he keeps talking about Jerome Powell and talking not too nicely. I think his latest was Too Late Jerome, I think is his nickname that he has for him, referring to the Federal Reserve being too late to cut interest rates. President of the United States, President Trump believes that the Fed should have cut interest rates already, and he's hoping for as much as a 3% decrease. So Fed speak, we're hearing a bunch of Fed governors speaking out over the last little while. We're going to touch on that. Trade and tariffs. What's the latest on trade and tariffs? We're hearing more and more that we're getting these sectoral tariffs, and we're hearing more and more about trade between the US and other countries that have already made a trade deal. Countries like ours, Canada, which has yet to make a trade deal. And obviously, trade between the United States and China is obviously a hot topic. And a bunch of tariffs that the US is threatening to put on places like India and China if they continue to purchase energy or oil from places like Iran and Russia. So we're going to touch on trade and tariffs and corporate earnings update. We continue to get earnings one after the next. Corporations report how well they've done the second quarter of 2025. We're going to talk about a few different types of names in different sectors and how they've fared. But again, you want to have definitely one eye on corporate earnings and how these companies are faring. So let's move on to our first topic, and that is Fed speak. So we've been hearing a lot, obviously, about from the president putting down the head of the Federal Reserve. And lately, we've received information that during the last vote at the Fed meeting, they had actually two individuals dissent, not agree with what the conclusion was. And that conclusion, as many of you know now, was to hold interest rates as they are, keep interest rate increases on hold or pausing, if you will. But two governors decided to go against the crowd or the group, and they've come out. A couple of them have come out and have said that they believe the Fed actually should be cutting rates already. We have a quote from both of those Fed governors. We can put the first quote up on our screen. There it is. And this is from Michelle Bowman. She is the one of the governors, one of the Federal Reserve governors. And what she said recently is with tariff related price increases likely representing a one time effect. And I'm going to touch on this idea of tariffs being a one time effect because, yes, it may be true, but I don't buy it. I believe that tariffs actually increase prices and those prices stay elevated for forever. I very rarely do you see inflation or prices drop once they've been increased. But what she says is that they're likely representing a one-time effect. It is appropriate to look through temporarily elevated inflation readings. I see the risk that a delay in action could result in the deterioration in the labor market and a further slowing in the economic growth. So Michelle Bowman believes that we're seeing a slowdown in the U.S. And I know that President Trump would love to see a cut in interest rates, but I think for different reasons. Michelle Bowman wants to make a cut in rates because she thinks that the U.S. is slowing down, that we need to see interest rate cuts to help stimulate a slowing economy. Our second quote that we have is from Christopher Waller, another Fed Reserve governor. And what he says is there is nothing wrong about having different views about how to interpret incoming data and using different economic arguments to predict how tariffs will impact the economy. But I believe that the wait and see approach is overly cautious and, in my opinion, does not properly balance the risk to the outlook and could lead to policy policy falling behind the curve. And what he is saying is that if the economy falls too quickly, the Fed could be behind the curve or wait too long before cutting rates to stimulate, and that it would be a big issue and problem for the economy. So that's what the two Federal Reserve governors that I guess disagreed with the pause in interest rates, but that's what they were saying. And again, it's as I was saying in my previous segment about a slowing U.S. economy, it just depends on what you are looking at. You can look at the glass as half empty or half full. I think these two Federal Reserve governors are looking at it more as closer to empty than full, whereas the head of the Fed, Jerome Powell, is saying there still isn't enough information or reason to cut interest rates. We'll see over the coming days and weeks if more Fed governors speak out, in terms of whether they believe the Fed should be cutting rates next meeting in September. With the recent data that has come out with respect to jobs growth, now the chances of a rate cut in the U.S. for the month of September is now up to 80% once again. It was 80%. And then when we saw some strong economic data, GDP, retail sales, it dropped back down to below 50%. And now it's back up to about 80% once again. Our first chart here shows the U.S. unemployment rate. And you can see here 4.2%. It has definitely moved up from about 3.5% back in 2023. So a slow grind higher, but 4.2% is pretty much full employment. And so when you look at this number, it's hard to argue for a interest rate cut. Why would you want to cut interest rates when you're seeing unemployment at 4.2% or pretty much full employment? Yes, unemployment is moving higher, but still nowhere near high enough, in my opinion, to justify the Fed cutting rates. Our next chart here shows retail sales. And we actually had this chart, I believe, on our last show. And you can see here in June, retail sales were very strong, up 0.6%, a great rebound or a nice rebound from May. And on the right-hand side of our chart here as well, percent change in retail and food services sales from the previous month. You can see a huge rebound in the month of June. So again, focusing on retail sales, focusing on the unemployment rate, focusing on GDP, focusing on inflation creeping towards 3%. All reasons why I believe the Fed should be, standing pat. I don't think we should see rate decreases. I don't think the Fed should cut rates. I know the President of the United States would love to see rate cuts so that the debt levels or the amount of debt or interest on the debt that the U.S. is paying will come down. The debt now, the interest they're paying over $1 trillion in the U.S. Just an astonishing number for any country. But President wants to see rates come down. He believes that this is a great way to reduce interest that they'll have to pay. So unfortunately, the Fed doesn't look at it that way. That's not their mandate. Their mandate is full employment and stable prices. So we'll have to see if the pressure on the Federal Reserve gets to them and eventually they end up cutting rates. Our second topic, or I guess second topic out of the top three things to consider before you make your investment decisions, is the continuation of trade and tariffs. And our first chart actually shows exactly where we stand on tariffs today. And you can see here on the left-hand side, maybe we can make that just a tiny bit bigger, but on the left-hand side, you could see that the European right off the top, you could see where their tariffs were, which is the gray. There you go. Thank you for enlarging that. You could see that once upon a time it was 30%. And with the recent trade deal, it dropped down to 15%. Moving down the ladder, you could see Canada. Canada is up to 35% on non-USMCA compliant goods. The good news is most of the goods that we ship down to the US is USMCA compliant. And I think that affords the Prime Minister time to make a good deal, not necessarily a quick deal, but a good deal for Canadians, because most of the things that we send to the US is USMCA compliant and therefore has no tariffs on it. But if you go down the list of countries, United Kingdom, 10%, Brazil is a big one. Brazil could be as much as 50%. I know they were talking about that. I know here it says 10%, but Brazil could be a lot larger. I know that the Swiss, 39%, trying to work out a deal. Hopefully that can happen before I believe it's an August 7th deadline. And then you just go down the list. So you can see here clearly that the tariff rates have gone up. And again, this is where I want to touch on this idea of inflation as a one-time effect, or has a one-time effect. And I'll explain why the president and many economists and many of the Federal Reserve governors believe it's a one-time effect. Let's put up the definition of inflation, and you're going to see exactly why that is. Inflation, how does it work? Well, inflation represents the rate at which the cost of goods and services increase over a period of time. So it's the rate of change of prices, not about how much the prices go up, but by how much that rate of change is. So for example, prices can be, for something $100 and it goes up to $105. So the rate of change is roughly 5%. And then the next time it could go up only by $1. So now the rate of change is something even less than 1%. But you're still now at $106 for an item that once upon a time cost $100. So the inflation rate would show that it is coming down from, let's say, 5% to 1%. But in essence, it's the consumer that is now paying over 5% more for that item. And that inflation compounds over time. So yes, I agree that the inflation is a one-time event. You get a spike in prices perhaps because of the tariffs, but then shortly after that, prices won't go up anymore, right? They just go up that one time. But it's the people that continue to see the higher costs. And we're hearing from businesses all the time We're hearing from businesses talking about um, how they're having to eat more of the cost, whether it's GM or Ford, telling us that they're, spending hundreds of millions of dollars just to because of the tariffs to eat some of these higher costs. We're hearing retailers, whether it's Amazon, whether it's Costco, whether it's Target, all these companies are raising their prices right across the board and different areas of their business. So it's definitely starting to affect everybody. And all of those companies that were very good at shipping goods prior to the tariffs at the lower prices, they probably shipped 3 to 6 months worth of inventory. All that inventory has pretty much uh, been sold or worked through, especially in the automobile sector. And now what we're left with are higher prices. Our next, I guess we'll call it illustration, talks, I think, really well about the rate of tariffs that the U.S. is seeing right now and state of U.S. tariffs as of July 2025. There you have it. And you can see here that the current tariff rate based on the Budget Lab, which talks about the current tariff rate, you can see it there. Consumers face an overall average effective tariff of 18.4%, the highest since 1933 for Americans. And it says after consumption shifts, the average tariff might go down a little bit to 17.5%. I can tell you, what, a year or two ago, that rate was probably 2, 3%. So you can see how much prices have moved higher over the past, let's call it 7 months. And there is no end in sight. According to the Trump administration, there will always be a baseline tariff, whether it's 15%, 10%, and you couple that with some of the higher tariff rates on other countries, 20%, 30%, et cetera. That's how you get that 15 to 20% inflation rate for U.S. consumers. And I know the president just yesterday, I saw an interview on CNBC, and he talked about how much money he is taking in, or the U.S. is taking in. And I guess my question would be, at what cost? And to me, it's the cost to the consumer. And the president and his administration just doesn't see it that way. He believes it's at the cost of the exporting nation that they're swallowing the costs. I guess time will tell. Our third point that I want individual investors to consider before you make your investment decisions are corporate earnings. And we are pretty much, I would say, about 2/3 of the way through the corporate earnings season, especially in the US. In Canada, we started a little bit later. But I wanted to highlight a few stocks that have caught my eye in the past few days. Let's put up a chart of Palantir. Palantir, which has been one of the biggest benefactors of AI, artificial intelligence. I know a lot of people, if I ask you what has been the best performing stock as of late because of AI, for example, this year, a lot of people would say NVIDIA. And the actual answer is Palantir. Look at that chart of Palantir. It's done extremely well. A lot of government contracts incorporating artificial intelligence into their business model. Just a phenomenal stock. Very expensive. So all of you that are watching, no, I'm not recommending buying this stock necessarily. I think you have to do your homework and consult your investment advisor. If not, you can consult me. It is a stock that is very, very expensive and very volatile as well. Our next stock is one on AMD, Advanced Micro Devices. This is the second largest chip maker in the United States. Obviously, NVIDIA, $4 trillion company today, is the largest. AMD is a distant second. They just reported earnings yesterday. They came in and around expected. They didn't really do anything too extreme to get investors too excited, although the stock initially went up when they heard how they performed, went up a little bit. But AMD has had a tremendous run. Look how much the stock has gone up. I think it's gone up close to 45, 50% year to date. It's just been on a tear ever since it hit those lows back in April. So a name like AMD probably was a great opportunity. And now, again, getting close to around a 40 times earnings, 40 times forward earnings per share. When you start to see numbers that high, I think it's I don't want to say a red flag, but definitely you're probably not going to be looking to buy much at these prices. Another name that I wanted to bring up, and it's Caterpillar, a name that we talk about from time to time. Obviously, very important for construction. And you can see the chart here, a phenomenal run higher. They actually disappointed earnings. They came in below expectations a little bit, but not too much. And the market, as the market does lately, seemed to overlook it. And Caterpillar, again, initially was higher on the earnings, but yesterday, for example, we saw markets sell off a little bit over the afternoon as we started hearing some more information about tariffs and future tariffs and all that, and that kind of spooked the market a little bit. We also saw that negative, slightly negative services number, which took the market lower as well. Our last, or actually our second last chart, or third last chart, I should say, is one that I wanted to touch on because not often we see positive earnings with Pfizer. Pfizer came in with positive earnings. And actually, we saw positive earnings. I take that back. The last quarter as well, Pfizer took up expectations for the future. So they had a good day in the market once they reported earnings. Yesterday, before the market opened, stock was up throughout the day, over $24 a share again. But again, it's still well off where it used to trade into the low to mid 30s. Stock or shares still pay a fantastic dividend of in that high 6% range, 7% range. So a name that if you're looking for income, maybe you want to take a look at Pfizer. But for a while now, it's been, as you can see by the chart, we call that dead money. Unfortunately, the stock hasn't been much of a mover. Walt Disney. Walt Disney reported earnings this morning, and this is a name that you can see here has had a good run, kind of plateaued in around 100 and let's call it $120 a share. A name that I think has a bright future, obviously with CEO Bob Iger coming back to the company. It's done wonders for the company. So a name like Disney, I think you could take a look at. And last but not least on our list of chart names and corporate earnings to take a look at is Eli Lilly, the largest U.S. pharmaceutical, largest pharmaceutical in the world, actually. I still believe this name becomes the first trillion-dollar pharmaceutical company. You can see how volatile the name has been. For those that don't know, Eli Lilly has the GLP-1 drugs, the weight loss drugs, Alzheimer's drugs, a tremendous pipeline of drugs, potential for a few blockbuster drugs there in the future. So it's not just putting all its eggs in the weight loss category. And I think it's a name that well off its highs, over $100 a share off its highs. I think it's a name that for some you could take a look at going forward. So corporate earnings season has been, I guess, in general in the US, fantastic. In Canada, maybe a little bit soft, at least to start. But corporate earnings in the US beating expectations, most stocks over 80% beating expectations. And that is a good thing. And that is, again, another reason why we believe the economy in certain areas is still pretty strong. And probably another reason why the Federal Reserve isn't too quick to be cutting rates. So corporate earnings, again, is one of our three topics that I think individual investors should be focused on before you make your investment decisions. Stock swings. We've seen many of them over the past, let's call it 7 months, ever since the new administration took office, President Trump. Stocks have been quite volatile due to many things, geopolitical events, tariffs, wars, etc. It's been a tough time for investors to understand what's going on. And I wanted to highlight one of the questions I received recently, and it has to do with Meta. And we can actually put up a chart of Meta. Meta, formerly Facebook, the parent of Facebook and Instagram and WhatsApp. Meta owns all of those. And obviously the Meta glasses and everything falls under the Meta platform. And we could see here that Meta, when they reported earnings, it basically was a straight line higher. The stock was up over $80 or approximately $80 a share that day. Unbelievable. 10% gain, over 10%, 11% gain that we saw just a few days ago. The next day, we had some negative news and we saw jobs data coming out, and that was negative. And we saw Meta fall $25 a share, roughly, or $23 a share. And that left a lot of investors saying, how does this work? How can a company go up $80 a share one day and then go down by $23 a share the next when really the news hasn't changed? And that's a great question. And the answer is actually in our next chart, a chart of the QQQ, Invesco QQQ. And this is a ETF that monitors, for example, all the tech stocks. And you could see it here. Look at that drop again on that Friday, that this past Friday that we received those jobs data. And then once again, a straight line back up. So what I wanted to show is this. It's not individual investors selling Meta, although I'm sure some may have taken some profit off the table. It's the ETFs. So when the market has negative information, negative data, or data that is looked upon as negative, what do investors do? Well, investors, computer programs, the algorithms, they sell things such as ETFs. And inside ETFs are stocks like Meta, other stocks. It could be another type of ETF that sells perhaps, or that has inside of it CIBC or Bank of Nova Scotia or an oil company or a retail company or a pharma company. And you're, as an investor, if you may own the individual stock and the stock may be doing extremely well, but if individuals are selling the ETFs that stock is in, well, that stock is going to go down just like the ETF as well. Because when you sell an ETF, you're selling what's inside. And for a lot of investors, when they see something that makes them nervous, they sell what they can, not what they should. And so they'll sell off ETFs, they'll sell off some of the high flyers. And that's why you can get I guess, a pullback, a significant pullback the next day after a significant increase. And I will say that if it's a good company like a Meta, that is opportunity. That gives us opportunity to perhaps buy more shares of Meta or any other company that does what Meta did on that day or the following day as well. So hopefully that gives some insight as to why a stock can fall. A lot of the time, it's not because individual investors are selling that stock. They're selling the index or the ETF that stock is actually trading in. So for those that own Meta, I would continue to own it. You may want to trim some of the profits as it moves higher, but I still believe Meta is a great investment to own over the long term, and the company should continue to show this by higher earnings or higher earnings per share, higher revenue as we go quarter to quarter in the years ahead. So the president has called on the top 17 pharmaceutical companies in the United States to lower drug prices. And that combined with him saying recently as well that he can foresee tariffs placed on pharma of up to 250%. So if a pharmaceutical company is importing drugs from outside the US, at some point over the next year, year and a half, as the president says, they may be paying a 250% tariff on that drug. And but he says now that he wants to see these pharmaceutical companies bring down the price of their drugs. And as we can put up, there's a letter to an example of a letter. There it is, to Albert Bourla, the CEO of Pfizer. And in there, you can see what he talks about. He actually points out 4 different things. He calls it the most favored nation pricing. So what that means is he wants to see, President Trump wants to see the pharmaceutical companies bring down their prices to match what other countries have as pricing. So he talked about recently Europe, that Europe pays a tenth of this of pricing that the US residents pay, just a tenth for the same drug. And he wants to see the drug companies bring down the pricing to match the lowest pricing that exists in any country around the world. So he wants us to have that most favorite nation pricing, or he wants the US to have that most favorite nation pricing. He wants to guarantee pricing for newly launched drugs as well. And this is tough because we know that it takes approximately $1 to $2 billion, that's with a B, $billion, to bring drugs to market. You're going to have a lot of failures. You're going to have a lot of drugs that come to market. And we know that there's been a 60% increase in drugs coming to market over the last little while. And that's fantastic. That's incredible. The number used to be a lot lower than that. But you can imagine the cost of producing these drugs and how many people they're going to help, how much the research and development is helping with these, helping people, helping create these drugs for the people. And if you can't charge what you would like to charge as a pharmaceutical company, you can't help but to believe that that's going to affect the research and development, the R&D of a company. They're not going to be so quick to continue to spend dollar after dollar to try and come up with these new drugs. We also have here the increase in revenues that these drug companies have overseas. He wants to see that brought back to the U.S. and help U.S. Patients here, in the United States. And that's going to be difficult as well. It's hard to see drug companies bringing back their profitability to the U.S. These companies need to take their profits and use them to increase business, to, as I said, increase R&D. So difficult for companies to need to or have to do that sort of thing. He also wants to, the President of the United States wants to, President Trump wants to get rid of or eliminate the middleman. He wants to see drug companies sell direct to the consumer. And there's been a lot of talk that it's the middleman, the companies that are in the middle that regulate the pricing of the drugs. They're taking a big cut, and that's what's causing a lot of these drugs to be expensive in the US. So he wants to see the elimination of using these companies. And so that would hopefully bring down the cost as well. Well, once again, we know that that is difficult. That is difficult for the pharmaceutical companies. And when this announcement about the 17 letters that went out, this one being an example to Pfizer, we saw the market fall, right? We saw pharmaceuticals companies all around the world fall, especially in the US, due to tariffs, due to tariff talk, and also this call for a reduction in price. So we'll have to see how things play out. I know that the talk has been this type of talk has happened before, but it didn't really lead to much. But once again, the president has brought it up, and he says that tariffs on the pharma sector and drugs will follow. They'll start off small, but will increase over the next year and a half to as high as 250%. So I guess if you're looking at owning a pharmaceutical stock, you're going to have to do your homework, find out which pharma companies do business, much of their business in the US, that hopefully the tariffs will not affect them. And we'll have to see which pharma companies are going to see the biggest decreases in some of their drugs. So pharmaceuticals, they've been very volatile in the last few days. And this is why, because of the geopolitical speak and the tariff wars and what's coming out of the Trump administration, definitely causing some anxiety for these pharmaceutical companies. Manufacturing. As I said off the top of the show, we've seen manufacturing slowing down in the US, continuing to slow in the US, and hiring in manufacturing sectors slowing down. And just in general, we've seen manufacturing slowing down last 5 months or so. And I just find it ironic because the president is wanting to bring back manufacturing to the US, increase jobs, and that's just not what we're seeing. And it's no matter what he seems to want to tell everybody that this is going to be really good for the United States. It just doesn't seem to be working out that way. And a lot of people are starting to question, who's going to fill the jobs if he does bring back, if the President Trump does bring back business to the U.S. and bring back factories. We're seeing in many states, it's just hard to find workers, full employment. In states like Wisconsin and others, we are hearing that it is hard to find people that want to work. The chart that we have for this segment shows a lot of the different manufacturing data. Let's put that up. Here we have it. Manufacturing at a glance, we call it, and manufacturing PMI. So you could see the top one here, general manufacturing or manufacturing in general. You could see that in July it actually went down from June. But again, as I said earlier, if you see a number below 50, that means contraction. So you can see how many numbers are below 50 on this chart. And if you were to move to the right-hand side, you can see the trend and you can see the direction, contracting faster, 5 months trend. New orders contracting slower, 6 months. You can see the overall economy growing but slower. You see manufacturing sector right at the bottom, contracting faster, 5 months trend. So manufacturing, something that president is trying to bring back to the United States. The United States has become over the years a more of a services economy. Although we did see recent data showing that even services are slowing down. I think in general, businesses just don't know what to do. They're sort of paralyzed, not understanding or not sure where they're going to go, what tariffs and the effects of tariffs are going to have on their business. And they're just choosing not to expand and not to produce at this point in time. So, yeah, I think that going forward, the hope for the United States is that these trade deals, I should say, will bring some clarity, some certainty, and perhaps businesses will be able to pick up where they left off not that long ago, prior to the new administration taking office. But for now, even though the president seems to think that things are moving in the right direction, especially in just in general, but in manufacturing, I can tell you that according to this data, that is definitely not the case. Quick Hits, part of the show where I talk about 3 things that I've seen in the news lately and make a quick comment on each. I'm sure some of you have seen these and I find them quite interesting. First one, oil prices falling. Oil prices have been hovering in that mid 60 range, WTI, which is Western Texas. This is the US dollar figure for oil. And West Texas Intermediate actually is what WTI stands for. And we've seen it, as I said, 60 to 65. I think you're going to see that fall further as OPEC continues to increase production. The OPEC nations, led by Saudi Arabia, continue to increase production. Iran, Iraq, and they're up to about 527,000 barrels per day. Number 2, Citi raises gold forecast. Citibank, that is, raises gold forecast to 3,500 per ounce in 3 months. On negative U.S. outlook. So as things become more negative with respect to the economy, perhaps that means a weaker U.S. dollar and good for gold. Stagflation fears are back. We touched on that at the top of the show. Stagflation, slowing growth, but higher prices, something that central banks very hard to combat. So let's get to our first one, falling oil prices. And of course, we're going to show the price of oil. We have a chart on the price of oil. You're going to see the ups and downs. You had a big spike. It looks like, let's call it mid-June. Again, a lot of things can cause oil to spike. War in the Middle East causes oil to spike. The OPEC nations, OPEC meetings, depending on what they say, how much their production will be, causes oil to fall or spike higher. Right now, you can see oil has been pretty steady in and around, as I said, $65. But I look forward to that. I look for that actually falling below $60 a barrel. I think that's what President Trump wants. And as we know, the president will do whatever it takes to get that price of oil lower to again help bring down inflation that his other policies may be causing. Our second topic for our quick hits is Citibank causing oil, or at least predicting gold, I should say, to rise to 3,500 in the coming months. Again, they believe that the U.S. economy, the turmoil in the U.S. economy, the slowing growth in the U.S. economy, whether it's manufacturing or just slowing growth in general, will continue. And that should bring, I guess, the U.S. dollar down versus the basket of other major currencies. And if that is the case, the benefactor will be gold. And the Citigroup believes that the price of gold will spike or move higher to about $3,500 an ounce or even greater than that. Our third topic is one of stagflation. And this one's tough to show an example of. So we pretty much have a definition which we can put up, which, as I've said many times already on the show, an economic cycle characterized by slower growth, higher unemployment rate, and higher inflation. And I guess the problem, or the issue with this is, what do you do with stagflation if you're a central bank? Do you raise interest rates? Well, you can't, because the growth is slowing down. Do you cut interest rates? Well, you can't really do that either, because that could spur on more inflation. So what do? Well, central banks will tell you it is very difficult, and something that they just will probably tell you they don't know how to address. So stagflation, that is something that we're all keeping an eye on as we move forward with these tariffs. And I guess we could say the current trade war between the United States and all other countries around the world. Now, the part of the show that I like most, where I get to answer a question from the audience. This question I've actually received over the last couple of weeks once again, and I thought it was a good one because I think it could be a question that many people have. And here it is. I hold a lot of my investments in ETFs. Are they still safe investments based on the uncertainty we're currently living with? So ETFs, exchange traded funds, this is a managed product like mutual funds, but it is more, well, I would say for the most part, passively managed, or not as actively managed as we see with other managed products like mutual funds, where there's a manager that really pretty much every day decides what is in the fund, what is out of the fund, what stocks to have in the fund, what bonds to have in the fund, and what to remove. Usually ETFs will own a basket of stocks or bonds, and there's not as much movement in them, although there are actively traded ETFs. But so the question is, are they still safe? Well, I would answer that ETFs are no more or no safer than individual stocks. You have medium risk ETFs, medium risk stocks, higher risk ETFs, higher risk stocks. It just depends on the ETF itself. It depends on what sector of the market the ETF is following, what different type of investments are included in the ETF. And so for me to say, are they still a safe investment? I'm not so sure that I would agree that they're safe at all. I think it just means, or it just depends on the underlying investments within the ETF itself. ETFs actually have a fee attached to them, not as high as an MER, mutual fund MER, but they do have an ETF. So there is a cost that the ETF manager, if you will, or company charges all shareholders. It's a very small fee, but there is a fee nonetheless. So do you want to own the ETF? Do you want to own a mutual fund? Or do you have the option of buying a portfolio of individual securities on their own, which would be the cheapest way to do it? With that, I want to say thank you to all of you that had the time to watch our show today. As always, I hope all of you took away something from our show. I want to say that we will be back with our next show, as always, 2 weeks from today, Wednesday at 12 noon. I believe that is August the 20th. And until then, happy investing.